Inheritance is tricky, it's personal, sensitive, and almost never discussed openly. But the great wealth transfer is coming whether we talk about it or not, and it's too important for investors like you and me to ignore. Over the next decade, tens of trillions of dollars will flow from older generations into younger hands, reshaping markets and rewriting the rules of investing. I see the recent market volatility not as a reason to sit back, but as an opportunity, a rare chance to pick up great companies at cheaper prices and position myself for the long term. Whether you're lucky enough to expect an inheritance or not, you'll want to read on. After all, you don't have to inherit wealth to profit from where all that money is going. Part 1. Welcome to the Great Wealth Transfer. Yep, the world is headed for a tectonic, once-in-history shift in global capital. Over the coming 2 decades, tens of trillions of dollars will be passed down from the silent generation and the baby boomer generation to their loved ones in the Gen X, Millennial, and Gen Z crowds. It's the biggest wealth handover ever happening on a scale that could fundamentally alter how money is saved, invested, and spent. Estimates vary, but in the United States, roughly $84 trillion is expected to be passed down by 2045. For reference, that's nearly 4 times the value of all the goods and services produced by the economy in a given year, and the global figure could be even bigger. Forecasters see between $80 trillion and $100 trillion being passed down in just the next 15 years. Slightly different timelines, but the point is, it's a lot of money. Japan, home to one of the world's oldest populations, will see a staggering 550 trillion yen, 5 trillion change hands from elder to younger in just the next 5 years. And in Australia, wealth worth 3.5 trillion Australian dollars to 4 trillion is expected to be transferred over the next 20 years. Meanwhile, property-rich older generations in the UK, Germany, France, and Italy are also preparing to hand down their vast estates, and those untold sums will undoubtedly rise into the trillions too. But look, what makes this also historic isn't just the size of the numbers involved, it's the conditions that got us here. Earlier generations tended to see their savings wiped away by war, inflation, and economic shocks. But baby boomers have lived through a uniquely golden time. They were born after World War II and came of age in an era of peace, prosperity, and globalization. Homeownership was generally affordable, stock markets generally soared, and asset prices generally compounded in every decade of their lives. This good fortune allowed these folks, and to a lesser extent, members of the older silent generation, to accumulate wealth at a scale that was unmatched by any other cohort.
Today, they're poised to bequeath to their loved ones a pile of wealth that's been more than just preserved. It's been multiplied many times over by decades of rising markets. And because boomers had smaller families than their parents and grandparents did, those inheritances will be divided among fewer heirs. In other words, lots of people will soon be making serious money decisions. And when they do, they're likely to be driven by broadly different financial goals, risk appetites, and investment strategies than the boomers were. As these younger generations begin reallocating their inherited wealth, there could be changes in everything from portfolio composition to housing demand and spending trends. Part 2. 3 big implications for markets. The great wealth transfer is already picking up speed, and it's poised to really rattle the old-school 60/40 stocks, bonds portfolio. That's because the new wave of investors isn't content to stick people with the time-tested mix of blue chips and bonds. The younger generations have been cozying up to crypto, chasing big themes, and backing the creator economy. They've got a stronger risk appetite and tend to move a lot faster than previous generations did, which could mean wilder sector-to-sector pivots and more market volatility. As these fortunes shift from boomers to their babies, it's not just ownership that's changing, it's the whole investing mindset. Here are 3 major shifts to watch. 1. The traditional 60/40 portfolio could be appended. Boomers built their unprecedented wealth in an era that rewarded patience, dividend reinvestment, and blue-chip stability. Many also own long-term stakes in private businesses, from tiny local shops to powerful professional firms, but their children see things differently. Their generations tend to be driven more by alignment, not just returns, building portfolios that reflect their personal values, social causes, and cultural convictions. We're already getting some early signals, surging demand for thematic ETFs, things like AI, clean energy, space exploration, a deeper participation in crypto and other digital assets, and a growing investment in the creator economy's personal brands, online businesses, and community-driven platforms. If this trend gathers pace, we could see a decisive shift away from traditional market strongholds like utilities and legacy banks and into emerging industries like Web3, green tech, and biotech. That could splinter standard asset allocations, with more investors demanding customizable, conviction-driven portfolios, not the old 60/40ths blueprint. On the big picture level, the shift could mean a move away from low-yield assets like bonds and balanced funds and toward higher volatility stuff. As investing becomes more fragmented and narrative-driven in new hands, some of the old stalwart sectors could face steady outflows and valuation pressure. Meanwhile, some newer industries could enjoy surges of capital, and all of that could potentially destabilize legacy market structures, too. Risk appetites may rise. To put it simply, there are different psychological responses to slowly earned wealth and suddenly inherited wealth. For air investors, that lump of money can feel less like a nest egg and more like an opportunity, a springboard for experimentation and bold action. And that mindset could open the door to much greater risk-taking. We're already seeing signs of that. Heavier allocations to crypto, startups, and speculative tech. Rising interest in alternative markets like collectibles, carbon credits, and crowdfunding platforms. And shorter holding periods tied more to cultural trends than to long-term fundamentals. If this behavior scales up, the entire character of markets could shift. Sentiment-driven capital would gain influence, not just from meme stock speculative traders, but through fast, viral, emotionally charged TikTok-style investing. Portfolio decisions might increasingly reflect social momentum rather than, say, macroeconomic changes. Big institutional funds would no longer be the only heavyweight in the market, either, with behaviorally reactive flows potentially becoming a powerful market force, driving faster sector rotations, more sudden rallies and corrections, and higher levels of volatility. This investing crowd might be more agile, but they're also more unpredictable. And that could have markets swinging harder in both directions, with bigger wins and sharper losses playing out at a higher frequency.